Well, I'm going to save a little bit of time for the questions and answers. I know you have a lot of questions. But there were many things that you heard over the last 4 hours. I thank you very much for coming and staying through the presentation and really digging in to understand Keysight at a deeper level. The first thing, though, I'd like to summarize with is, what does Keysight do? We accelerate innovation to connect and secure the world. And not just for Keysight, but we do this for our customers. Every one of the products that are out there to create networks, infrastructures, wireless communications is enabled by Keysight. And the other key point that I'd like to make is we have transformed the business completely from 3 years ago when we launched it. At that point, we were more of a cash cow for Agilent, but now we have returned it to growth. We focused on industries versus products. We understand exactly what our customers want. We're bringing them not only hardware-centric products, but software-centric solutions. We're bringing them hardware, software, and the people resources on the upfront consulting, putting together systems, providing the software or even writing custom software, as well as all the services to make them very, very successful. When we've been doing that, you can see what's happening. Our organic growth has picked up. As Mark mentions, it's 10% the last 4 quarters, not including the acquisitions and the 39% total growth that we reported last quarter. And that's a big deal to actually move the needle. And you could ask, well, is that just a good market? Well, we compare ourselves to the peers. We are growing faster than the market, and that provides us great enthusiasm for the future. But we're not done. We're just getting started. As Mark mentioned, we're doubling the sales force. And on top of that, behind the scenes, as Jay mentioned, we've changed our whole R&D process to be more efficient. We've increased our R&D from 12% to 13 to 14 to 15%, and we're doing that very, very effectively with all of our customers. We're using our capital very efficiently. We're only doing M&A when we can get a return above the cost of capital, and we're executing very well on those components. But all of this, I think, provides a great opportunity for everybody. And what we're doing is we're doing it all with the Keysight leadership model. This ties together everything that we do, and it gives us a competitive advantage in the business. So with that, I'd like to say thank you very much for attending. And now let's open it up for the last Q&A for any questions you may have.
Just a quick question, Ron or Gui. Maybe could you speak to the interferometer business, the parametric test business, as you spoke to it on the semi side? And my question is the growth coming maybe out of the wafer construction dynamics and China's investment, or is Keysight have more content into the semi test marketplace? And then just last question, tie this on, would also be, is there any interest in back-end test given some of these same SoC dynamics and projected growth rates there? So lots of stuff in there.
Well, I think maybe, before we start, I just want to give a context that semiconductor business segments still represent a small part of Keysight's overall portfolio, so that we are not so, determined by the seasonal fluctuation of the semiconductor industry. But after saying that, perhaps a little bit of context. If I do miss some of your question, let me know, okay? So first part about parametric testing, our focus is primarily around front-end wafer fabrication. So a lot of the investment that we have been capturing is really around process node advancement. So it's not just for the low node count, but a lot of them are leading edge, and that's really where we get our greatest gross margin, okay? So that's one part. But the other part of it is that China investment also is a major stimulus for our business, partly for 2 reasons. One is that we do have a little bit of low-end parametric testing that cater for higher, not so higher resolution node count. So these are the 28 nanometer to 16 nanometer range, right? But Again, further down the road, China also is investing to upgrade the technology advancement. So we see that as a potential growth opportunity for us going forward. Now, the second part of the question around would we be interested in the back-end process? And I'm not sure whether you remember I have to bring you back to the old Agilent days. We used to have that part of the business, and we spun it off, and that was Verigi. You remember that part of the business, right? And one of the reasons why we don't believe that we want to go in at this point is because it's very the fluctuation is pretty tremendous, and we do not believe that it matched the current business model that we have. So our focus is really around the front-end wafer fabrication system. It's really all about enabling the IC architecture. It's all about enabling the process nodes. Okay.
And we focused a lot, obviously, on making sure business is more stable, moving from manufacturing to R&D in a lot of segments, increasing our software content, which is more of an annuity, just as services is, and increasing our services business, and all of those things coupled with our variable cost structure that we have in OpEx by going to outside contractors has given us much more bottom line protection during downturns. So that's an important aspect of the investment profile.
That's right.
I just have a quick follow-up with Neil. You spoke to 80 to 90% free cash flow conversion. I presume that's kind of on an adjusted net income number?
That's on adjusted net income.
Yeah, so big step up from the 65% that you've been running at. But why is it not 90 to 100?
Well, initially we're still in a position where we're funding our pension, so that's a driver. Our cash pension funding is higher than our pension expense, and likely will be for a few years, barring some favorable changes in interest rates. But again, we're focused on these things. We're still going to be making follow-on investments in growth, and we'll take this step and see where it goes from there.
Okay. Hi, Hao Xu with RBC. First of all, I want to say what a great job you've done in transforming the company and focus the company on a growth trajectory. Two, I want to thank you on behalf of many of my friends who are Keysight employees in Santa Rosa who are affected by the fire. So thank you for getting them back on their feet. My question is about the modular portfolio. We heard a lot about the customer-focused solutions approach. A lot of it is delivered through software. I wanted to dig in a little bit deeper on how does the modular portfolio come into play in that?
Sure. Our first focus is to figure out what is the best solution for a customer. And I'll give you three very quick examples. If somebody is crawling up a pole to look at a cell tower to figure out if their signal works and looking at the wires, they don't want to carry a 40-pound box with the power cord on it. So a big feature-rich box wouldn't make sense. Modular, which is a box that's typically just as big, but it has modular cards that are in it with a power cord, doesn't work. So there we would sell a battery-operated 8-pound device that could go up to 50 gigahertz, for instance. And in that case, that makes sense. The second point, or the second opportunity, is when someone wants to work in the lab and work interactively with the front panel, a feature-rich box is the best solution for them when it can be all contained in one box. If you're in production and you just care about setting up 2,000 lines, you may want something that's very dense that could be modular. So that's our first priority. But our priority was not to win in modular or just win in handheld. It was to provide the best solutions to our customers and to be agnostic on modular. And that's why we said we're going to stop reporting on modular. We just wanted to show you that we are there and that we're real and it's a big part of our portfolio. There's a lot of modular that's very low performance and low end. We don't plan to play there. But when you talk about higher performance modular, especially when you look at wireless, that's our area of expertise. and we're just taking the chips and components that we have for high end and putting them on a different board, a modular board. So our strategy is based around solutions. We're agnostics to any type of solution, and we hear from our customers that they trust us and view us as the trusted advisor because we're not trying to push or jam one form factor down their throat from a competitor or two that may have only one type of solution. We're not here to push the format. We're here to solve their problems.
Very good. So Patrick was up. Yeah.
Patrick Newton with Stifel. Two questions. I guess first on the automotive side, it was great to see some details around that business. I think you guys are doing very well, and that's an underappreciated part of the growth story at Keysight. But I'm curious, in the past you talked about EISG as being general purpose test, your largest business, semiconductor, and then energy auto. Given the order strength you've had and the revenue strength that you've had, can you comment as to whether auto is now your second largest subsegment business? And then within ScienLab, was there any customer concentration at all with that acquisition?
Okay. Well, first and foremost, I don't believe we do a breakdown sub-segment for EISG. But what I can tell you is that, at this point, the fastest growing segment within EISG is still the automotive segment. So general electronics still represent the biggest part, followed by semi, and catching up very fast is our automotive segment. Okay. Now, to your second question about ScienLab. ScienLab essentially is a company we bought based in Germany. And there are two reasons why we buy them. One is that it gives us extension into high power application, not just for electric vehicle, but also for the charging infrastructure. So there's tremendous opportunity there, point number one. Second point is that the concentration of ScienLab is primarily around Europe. A lot of the customers are tier 1 OEM in Europe, which we believe we could leverage the solution to the rest of the world. I think if you combine with the global reach that we have, I think that's really some of the value that Mark can bring to China, to US, and so on. And we are now going through that process. So pretty exciting, and we believe that the trajectory of growth for automotive will continue to be strong going forward. Okay. Yep.
Obviously, to make an acquisition, you either have to get cost synergies or revenue synergies or some combination of the two. And clearly, cost synergies are the things that are easier to predict. There's no doubt about it. But ScienLab is a very different case. Here's somebody that has a solution that is the best solution in one of the hottest markets, and they have no ability to scale. They're a very small organization. They need someone to provide all the production capabilities, and they need people to provide more sales support and solutions. So we can provide them with instantaneous ability to scale, and that's exactly what we're doing, and the prospects are excellent.
And then second question was to Marco Rubio.
Give me a glass of water, please.
On that, I appreciate the updated model. Something that struck me was that on the gross margin front, you're guiding 61 to 63%. I think if we normalize the inventory write-down in your last quarter, you've actually been in that range for 3 consecutive quarters. You have communicated a higher software mix. I think if I look at the growth rates you're targeting, they're higher in Ixia, which is margin accretive. So my question to you is, why is that not an area of leverage in your business model?
Yeah, so we've been at the low end of that, in the 60 to 61% range, really since the acquisition of Ixia, and we do see a room for further improvement into the 200 to 300 basis point range. Obviously, we've got a lot of moving pieces in our business. We have a broadest portfolio of end products in the industry, as you think about gross margins, while we're adding software, on the one hand, which is net favorable to gross margin, we're also adding services, which is equal profitability, but it's a lower gross margin, lower expense way to get there. And so those two things kind of work in opposite directions. And so we do believe that we have room for further margin expansion, both gross margin and obviously the 400 basis points that we're getting on the operating margin line. But there's a lot of different moving pieces that go into that improvement.
But I would like to say, obviously, Ixia software, but also R&D, our shift from manufacturing to R&D. Everybody remembers when we won a $250 million deal back in 2012, 2011 or 2012 from one customer, and we walked away because we didn't think it was the right long-term business. And we've seen other people walk away from it since, and our focus has been on improving margins. Also, it wasn't that we were not cost focused. We have been cost focused, but our number one objective by far was to get the growth going. Now that we've got the growth going, we're turning up with our model, we're turning up some of the lean activities to another level. And your initial comment is a really important one that I don't know if we've mentioned. We built a lot of backlog, obviously, because of the fires. We had said we were going to delay $100 million worth of revenue shipments that we typically would see, and we actually were $56 million ahead of that in the last quarter. But we did build $226 million in backlog over the last 2 quarters and $289 million over the last 4 quarters. We're building it. So that's a very healthy balance. It also provides great efficiency for the company because at the end of the quarter, it's not a typical quarterly scramble. There, people can continue to drive orders and not have to rush and have our sales folks worrying about matching up shipments with our backlog. Thanks for the question.
Any questions?
Somebody save us from Patrick, please.
I couldn't on the growth side, if I just look at the target of 4 to 5%, if I could look back over a 20-year span, a 30-year span, doesn't really matter. Anything that's multi-decade, test and measurements, 2% grower. So you're targeting the industry at being 3 to 5%. So first, I'd like to understand what's embedded in that 3 to 5% being kind of above the long-term growth rates. And then secondly, I think you made it clear that you do have some, you have 5G that's helping you out, you have automotive that's helping you out, some of the other businesses, but can you help us understand how you stack above the market growth rate? And the only thing I'm concerned about is I think the share gains or the outperformance of the market seem pretty logical, but that 3 to 5% industry piece might be a little bit aggressive. So I'd like to understand what you've embedded there.
Sure. We agree with you. We see 2 to 3% long term, but over the next 3 to 5 years, we do see 3 to 5%. When we look at what's going on in 5G and how early we are in the cycle, that's huge. And then on top of it, when you look at automotive, that's another a great driver of the industry. But 5G in communications is not only over half of our business at $1.7 billion, but it is a large industry. So we think that will take up the average over the next few years. Longer term, it's 2 to 3, but we believe strongly that we'll be able to take share. We're taking share not only because we're providing total solutions, but we're targeting new solutions for the high growth areas. And when we make an acquisition, we look at not only what is our ROIC relative to our WACC and make sure there's enough of a delta there, but we also look at what the growth rate is of the company that we're buying. So for instance, when we look at Ixia, we see great potential there for longer term growth to beat let's say the market 2 to 3%. Thank you, Patrick.
So I think we got time for another question or two. Sure, right here. Mary, up front. Right here to the left.
Right there.
To your left, yeah.
Hi, thanks. My name's John Brewer, and in listening to your presentation, I think it was Jay, I wanted to ask about the PathWave solution, and is that envisioned to be primarily for Keysight products, or are you looking at that being applicable across platforms?
Great question. It's starting out with support for Keysight instruments and solutions, but it is open and it's designed to communicate and pick up other companies' products as needed, as customers need to build out their solutions and expand. So that's part of its value.
And one more, I heard a lot about software and services as a focus. Are you looking at extending these services or these software applications beyond the test environment onto the platforms themselves and as a recurring revenue stream there is licensing for your software.
I think there are some early ideas for that. Maybe John could comment on that as well.
Yeah, so the way we really look at things is in the total solution. So covering the hardware and the software together is really the focus. So yeah, there'll be new things coming covering the software portion of it as well, if I understood your question correctly.
One thing I'd like to add about PathWave, we underplayed PathWave today, otherwise we all would have been talking about it. It really is a revolutionary new platform. We looked at everything at the marketplace, we looked at where the customer pain points are, and PathWave spans every aspect of development, from initial design and research that is done, all the way through to developing prototypes, looking at validation and verification in R&D, looking at operations out in the field, and connecting those data points so we could speed the development process. Any customer, Qualcomm, Intel, Apple, Samsung, they would do anything to speed up their development. Imagine if they got their devices out 3 months sooner or 6 months sooner, how much that's worth to them. That's why in R&D, the cost isn't really as much, an issue for the piece of equipment. It's really what's the result that they can provide. But we played it down because we're just announced this framework. We're going to build it out over years and provide the type of results that you've seen us provide in modular, we grew that from 0 to over $200 million, in software, which we talked about, which is over $500 million now, in 5G, which is growing triple digits, okay, and was almost triple digits all of last year. You're going to hear a lot more about PathWave. And being open is very, very important. So some of the software packages that we have, as well as the competition has, they'll be able to plug into that and plug into this workflow. And it's really a cloud-based solution that ties everything together. Now, customers can run it locally. There's more variations. But you bring up a very astute observation about PathWave and how important that is.
Very good. We got time for one more question. Okay, Hole?
I'll make it quick. This question is for Mark and maybe Satish as well. In looking at the addressable market in the network test and network visibility side, in your slide you have network visibility being 1.5 billion, much higher growth rate, network tests, lower growth rate, and combined you have high single-digit growth rate for those two. The question is, how should we think about the investment focus on this? Why not spend more on the network visibility side, and what's preventing you from doing that if that's the case?
So just to answer the question directly, this is a conversation we have regularly at this point. Being a relatively new entrant into the visibility market, we're not the main player today. We're kind of moving into that space. As I mentioned, we started in around 2012. The reality is that we have to balance all of the different elements. It would be very easy to overinvest at this point in time. So what we've been looking at is making sure that that's a balanced position from how much we put in R&D, how much we're spending in go-to-market, and of course there's a whole discussion around awareness and so forth. And I think if there's one thing that's very encouraging I've seen over the last 3 to 6 months as I've been getting closer to Ixia is that actually we've been gaining a position from a more of an awareness standpoint, and that really is beginning to drive the front end. Now, as that begins to pick up, I would expect we will start to put more into the R&D portion. But I think we've seen, and across my experience in the company, it's very easy to get, see the bright shiny object and get really seduced by that, go too hard too early. These things really do take time, and customers, frankly, we're talking about enterprise customers largely. They're running businesses, they're moving into digitization. As I mentioned, only 40% of industry is really digitized, even with really deep penetration in, let's say, retail or media or tech. And so there's a long way to go. Customers are not as quick to change as maybe we think, and so pacing ourselves, I think, is going to be very important not to outstrip the demand.
Okay, very good. Well, Any last comments, Ron, and we'll wrap up. And just before, Ron, you finish up, just there's box lunches for you on the way out, but the management team will also be around to field a few questions if you'd like to talk with them. So, Ron, back to you.
Yes, again, thank you very much for coming and spending the morning with us. I would like to say that I've been in this industry, as I mentioned before, for 34 years, and this is the most exciting time we've ever had. The growth opportunities that exist really are moving into our area. It's not medium performance electronics. It's moving up to wireless devices, which is really where our core competencies are tremendous and better than anyone else's. We have a track record of performing, as you've seen in our results. We've guided 13 quarters in a row, and we've met our guidance or exceeded guidance every single quarter. We're increasing right now our growth rate expectation. We're increasing our operating margin expectation by 400 basis points. And we just were authorized $350 million to do share repurchase to eliminate dilution. So thank you very much for coming. Have a great day.